Picture a retired schoolteacher in Ohio, sitting at her kitchen table every April, writing a check to the IRS for money she genuinely believes she owes. She is not avoiding anything. She is not bending any rules. She simply has no idea that the tax code she has lived under for 30 years contains a handful of accounts that Congress built, named, and left sitting there in plain sight. Accounts where money can grow for decades and come out without the IRS ever laying a hand on it. Not deferred, not reduced, untouched. That is not a loophole somebody dreamed up. That is the actual law, written down, available to almost anyone who knows where to look. And here is the uncomfortable part. Most retirees never find out, not because the information is hidden, but because almost nobody in their financial life is paid to tell them. Today we're going to walk through 3 of these accounts together, in plain English, so you can have a much more informed conversation with your own tax or financial professional. Before we go any further, let's be clear about what this video is and isn't. I'm not a financial advisor, an accountant, or an attorney, and nothing here is personalized advice for your situation. Tax law is genuinely complicated. It changes every year, and how these strategies apply depends on your income, your state, your age, and decisions only you and a licensed professional can make together. What I want to do is give you the plain English foundation, so that when you do sit down with a CPA or a financial planner, you're asking sharper questions and you understand the answers. Think of this as the conversation a well-informed friend might have with you over coffee, not a substitute for professional guidance. Here's why this matters right now. If you're approaching retirement or already in it, you are making decisions this year and next year about which accounts to draw from, and those decisions can quietly follow you for the rest of your life. Pull money from the wrong place at the wrong time, and you might not just pay more in income tax, you might push more of your Social Security into taxable territory or trigger a higher Medicare premium without ever realizing what caused it. None of that is dramatic or sudden. It happens slowly, one tax return at a time, which is exactly why it's so easy to miss. So here's what we're going to cover. First, an account that lets your money grow for decades and come out completely untouched by federal income tax, and that, used carefully, can also help protect your Social Security and your Medicare premiums from creeping up. Second, the only account in the entire US tax code that offers 3 separate layers of tax benefit at once, and why most people who have one only ever use a fraction of what it actually offers. And third, a tax bracket that already exists in federal law, sitting there year after year, that allows certain retirees to sell appreciated investments and owe the IRS nothing on the gain. If any of that sounds useful, stick around, and if you find this helpful, consider subscribing, because we cover one of these real-world planning topics every single week. Let's start with the first account, the Roth IRA, because understanding it well makes everything else easier to follow. With a traditional IRA or a traditional 401k, the arrangement is simple. You put money in before tax, it grows, and the government collects its share later, on every single withdrawal, taxed as ordinary income for as long as you're taking money out. A Roth IRA flips that arrangement. You contribute money that has already been taxed. From that point forward, the growth, the dividends, the years of compounding, none of it is taxed again, as long as you follow the rules around age and how long the account has been open. Imagine someone who contributes a modest amount every year, starting in their mid-40s, investing it in a simple, diversified index fund. By the time they reach their 70s, that account could realistically be worth several $100,000, and every dollar that comes out is free of federal income tax. Compare that to the same amount of money sitting in a traditional account, where each withdrawal adds to your taxable income for the year. Now here's the part that surprises a lot of people. A Roth withdrawal isn't just untaxed on its own, it's also invisible to 2 other calculations that matter a great deal once you're retired. The IRS decides how much of your Social Security benefit is taxable using something called combined income, which adds together your other taxable income, certain non-taxable interest, and half your Social Security benefit. Cross certain thresholds, and up to 85% of your benefit can become taxable. A withdrawal from a Roth account doesn't count toward that calculation at all. Separately, Medicare uses your income from 2 years earlier to decide your monthly Part B and Part D premiums, and above certain thresholds, it adds a surcharge that can meaningfully raise what you pay, sometimes for the entire following year. Again, Roth withdrawals simply don't factor into that number. None of this means a Roth is automatically right for everyone, or that you should restructure your accounts without guidance, only that it's worth understanding how differently this type of withdrawal behaves compared to a traditional one, and asking your advisor whether it fits your picture. One more thing worth knowing. There are income limits on who can contribute directly to a Roth IRA, and those limits are adjusted by the IRS most years. If your income is above the threshold, there's a legal, long-standing method often called a backdoor Roth conversion, where you contribute to a traditional IRA and then convert it. It involves real tax mechanics, including something called the pro rata rule if you already hold other traditional IRA money. So this is absolutely a conversation to have with a tax professional, rather than something to attempt based on a video. Let's pause here for a story. Imagine a retired couple, both around 66, who built a modest Roth IRA over 15 years of steady contributions alongside their regular retirement accounts. When they retired, almost all of their other savings sat in traditional pre-tax accounts. Every dollar they needed beyond Social Security came from those traditional accounts, and each withdrawal nudged their taxable income a little higher. One year, without realizing it, that extra income pushed them just over the threshold that triggers a Medicare premium surcharge, an unwelcome surprise that arrived nearly a year later in the form of a letter. Had they drawn a portion of that year's spending from their Roth account instead, the math might have looked different. This is an illustrative example, not a guarantee of outcomes, and every family's numbers are different, which is exactly why working with a professional who can see your full picture matters. Now let's talk about the second account, the Health Savings Account, or HSA. Most people who have one think of it the way it was probably explained during open enrollment, a place to park a little pre-tax money for co-pays and prescriptions. Used that way, it captures only part of what the account can actually do. An HSA, when you're eligible for one through a qualifying high-deductible health plan, offers 3 layers of tax benefit at the same time, which is why it's often described as the only triple tax advantaged account in the federal tax code. Money goes in without being taxed. It can be invested, not just held in cash, and it grows without the IRS taking a cut of the gains along the way. And when it comes out for a qualified medical expense, it isn't counted as taxable income at all. Here's the detail that changes how people use this account once they understand it. There is no IRS deadline for reimbursing yourself for a past medical expense. If you pay for a medical bill out of pocket today and simply keep the receipt, you can reimburse yourself from the HSA years later, even decades later, completely tax-free, as long as the expense happened after the account was opened. That means someone who pays smaller medical costs out of pocket during their working years, while letting the HSA balance invest and grow untouched, can arrive at retirement with a meaningful balance and a stack of documented receipts representing a source of tax-free money they can draw on whenever they choose. For 2026, HSA contribution limits are $4,400 for individual coverage and $8,750 for family coverage, with an additional catch-up amount available for those 55 and older, figures the IRS adjusts most years, so always check the current numbers before planning around them. Eligibility depends on having a qualifying high-deductible health plan, which is something to confirm with your insurance provider or HR department. Now to the third piece, a bracket that exists quietly in federal tax law, the 0% long-term capital gains rate. Most people know that long-term investment gains are taxed, often around 15% for many filers. Fewer people know there's a bracket beneath that where the rate is 0. If your taxable income falls below a certain threshold, a number the IRS adjusts annually, and one your tax preparer can confirm for your filing status, long-term capital gains can be taxed at 0%, not reduced. 0. Why does this matter, especially in retirement? Because income often drops in the years right after someone stops working, before Social Security and required withdrawals from retirement accounts fully kick back in. That window can create an opportunity for those whose income genuinely falls low enough to sell appreciated investments sitting in an ordinary taxable brokerage account without owing federal tax on the gain. And because the rule preventing you from immediately repurchasing an investment, known as the wash sale rule, only applies to losses, not gains, some investors in this position are able to sell an appreciated position and buy it right back, which can reset what's called the cost basis higher for future tax purposes. This is a nuanced strategy with real consequences if timed incorrectly, and it depends entirely on your specific income picture for that year, so it absolutely belongs in a conversation with a CPA or financial planner, rather than something to do on your own based on a video. Let's talk about some common mistakes and misunderstandings people run into with these accounts. One is assuming an HSA is only useful while you're working. In reality, the receipts you save today can become tax-free income decades from now. Another is assuming a Roth IRA is only for younger savers with decades to grow money. While time certainly helps, many people open or convert into Roth accounts specifically in their 50s and 60s as part of retirement income planning. A third mistake is treating these three accounts as separate, isolated decisions rather than coordinating them. A large capital gains sale in the same year as a big traditional IRA withdrawal can push your income right back over the threshold you were trying to stay under, undoing the benefit of both moves. And finally, many people assume that because these strategies are legal and well established, they're simple to execute correctly. In practice, the rules around timing, eligibility, and reporting are detailed enough that mistakes are common, which is exactly why professional guidance matters here more than almost anywhere else in personal finance. So what are some reasonable first steps? Start by gathering a clear picture of where your money currently sits, how much is in traditional, pre-tax accounts versus Roth accounts versus an HSA versus ordinary taxable brokerage accounts. If you have access to a high-deductible health plan and an HSA, ask whether you're contributing the maximum and whether your provider allows you to invest the balance rather than leaving it in cash. If you're nearing or in the early years of retirement, ask a tax professional whether your income in a given year might fall into that 0% capital gains range and whether realizing some gains that year could make sense. And before making any large withdrawal decision, ask specifically how it might affect your Social Security taxation and your Medicare premiums down the line. These are exactly the kinds of questions a CPA or fee-only financial planner is trained to walk through with you, using your actual numbers rather than general examples. At the heart of all this is something simple. The size of your retirement savings and the size of your actual usable retirement income are two different numbers, and the gap between them is shaped by decisions most people never realize they're making. These three accounts each work a little differently, but they share a common thread. Each one, used thoughtfully and within the rules, can reduce how much of your money the IRS is ultimately able to count as taxable. That's not about finding a trick. It's about understanding tools that have existed in the law for years, sometimes decades, and making sure you're not leaving them unused, simply because nobody ever sat down and explained them clearly. Before you make any changes based on anything in this video, please talk with a licensed CPA, enrolled agent, or financial planner who can look at your actual tax return and your actual goals. Everything here is general education, not personalized legal or financial advice, and tax rules, including the exact dollar thresholds we mentioned, change from year to year and can vary depending on your state and your specific circumstances. If this kind of explanation was helpful, consider subscribing because we break down topics like this regularly and feel free to share this with a family member who might be navigating these same decisions. Protecting what you've built often starts with simply understanding the tools that are already available to you. Thanks so much for watching, and we'll see you in the next one.